Oil prices jump 3%. U.S. tariff threats on Russia trade deal optimism explained. Have you ever seen oil prices make a dramatic U-turn in just one day? That's exactly what happened yesterday, as crude oil markets surged over 3%, their sharpest rebound since late June. Markets thrived on two major developments: Washington's escalating economic warfare with Russia and a tentative truce in the U.S.-EU trade tensions. Let's break down how these geopolitical forces reshaped energy markets. First, let's talk about the Russia factor. On Tuesday, the White House announced plans to slap harsh tariffs and economic sanctions on Moscow in 10 days, unless Russia makes concrete progress in ending the Ukraine war. Analysts describe this as a high-stakes deadline that's forcing global markets to reassess supply risks. As Phil Flynn, a senior energy analyst, put it, "We've amped it up." Other countries are signaling they'll join America in tightening the noose on Russian oil exports. This isn't just U.S. pressure. It raises the specter of coordinated sanctions, which could drastically curb Russia's ability to sell oil abroad. But here's the twist. China might become an unintended casualty. U.S. Treasury Secretary Scott Bessent directly warned Beijing that continuing to buy Russian oil could trigger secondary sanctions, potentially including 100% tariffs on Chinese goods. This puts China in a difficult spot: comply with U.S. demands or risk severe economic repercussions. How's that for a geopolitical chess game? Meanwhile, there's cautious optimism about another front: the tentative U.S.-EU trade agreement. While both sides agreed to a 15% tariff on European imports, the deal avoids a full-blown trade war that could have destabilized nearly a third of global trade. Bob Yager of Mizuho summed it up: "It's not perfect for Europeans, but it's a far cry better than the alternative." Markets are breathing a sigh of relief that at least some destructive tariffs are off the table. But don't overlook the fine print. The EU has agreed to buy $750 billion of U.S. energy sources, about $250 billion annually over 3 years, and invest $600 billion in American projects during Trump's term. Analysts call these targets unrealistic. Is this just a political band-aid, or could it genuinely shift energy trade dynamics? This raises a critical question. Can the EU realistically meet these ambitious purchase commitments without destabilizing its own energy security plans? Domestically, U.S. crude stockpiles swelled by 1.54 million barrels last week, according to API data. While markets await official EIA figures today, this surge could signal mixed demand signals. However, traders are more focused on the Federal Reserve's decision today, with policymakers widely expected to hold rates steady, though some analysts speculate about potential dovish signals if inflation continues cooling. So, what's the big picture? Energy markets are caught between the risk of supply disruptions via Russian sanctions and demand stabilization from trade deal optimism. As markets digest these competing forces, one renewable question haunts analysts. What if U.S. enforcement on Russian oil exports actually succeeds? Could that tighten global supplies and drive prices higher still? Share your take. Do you think this transatlantic trade pressure will destabilize the oil market further? Or is this just a temporary spike? Understanding the factors influencing oil prices: tariffs, OPEC+, and U.S. shale production. Oil prices are at a crossroads this week, with global markets bracing for a tug-of-war between economic policies and energy dynamics. As of July 28, 2025, Brent Crude settled at $67.66, a drop from its previous week's high of $69.23, while WTI closed at $65.16, down from $67.31, and Oman crude remained steady at $70.72. This week's movements reflect a delicate balance between conflicting forces. Rising geopolitical tensions and trade policy. The U.S. still needs to finalize agreements with Canada, Mexico, China, and India, with a critical meeting between China and the U.S. in Stockholm set to decide the fate of these tariffs. If extended, the truce could prevent tariffs from surging back to 145% on the U.S. side and 125% on China's. But at what cost? Should the U.S. prioritize reducing tariffs over addressing deeper issues like rare earth exports or semiconductor restrictions? Meanwhile, OPEC Plus is pushing to stabilize the market. At its July 28th meeting, the group is expected to maintain its production increase of 548,000 barrels per day in August, a follow-up to earlier hikes in May and June. Analysts suggest this strategy is working. U.S. oil production fell to 13.27 million barrels per day, down from 13.37 million barrels per day, while oil rigs dropped 7 to 415, a sharp decline from pre-pandemic levels. Yet, even with these declines, prices remain stubbornly below $70. Why? Because traders are still wary of long-term supply risks, especially as the U.S. struggles to build a resilient rare earth supply chain. Stratus Advisors highlights that while the U.S. is ramping up domestic production, creating a reliable alternative to Chinese exports will take years and massive investment. And this is the part most people miss. Oil prices aren't just about trade wars or OPEC decisions. They're also shaped by global economic trends, geopolitical risks, and the slow pace of supply chain reforms. For example, China's rare earth exports rose sharply last month, but remain far below pre-tariff levels, while the U.S. pushes for stricter controls on Russian and Iranian oil. These moves may help the West secure energy independence, but they also risk destabilizing global markets. So, what does this mean for investors? While short-term optimism from trade deals may lift prices, the broader picture suggests a more cautious outlook. The next few weeks will test whether OPEC Plus can sustain its production cuts, whether U.S. shale producers will scale back, and whether global demand will hold up against falling prices. The answer to these questions will determine whether oil prices break above $70 or settle into a prolonged period of volatility. For a deeper dive into this week's market dynamics and projections, visit our short-term outlook report. And remember, in a world where energy prices are shaped by politics, technology, and time, staying informed is your best bet. What do you think? The U.S. should focus on trade deals or long-term supply chain reforms? Share your thoughts in the comments below.